But so much to talk about today. We saw the Dow Jones did close down on Friday, and it was a volatile week, no question about that. But one of the big reasons why you were seeing movement in the equities market is because of the bond market. Let's explain that, Derek.
Well, we've talked for a long time that we felt that interest rates were poised to rally as the economy reopened, and it kind of surprised me that they hadn't rallied prior to this. But, we talked a couple of weeks ago that one of the linchpins of the bull argument on stocks was that interest rates were going to remain low for longer. And we know the Fed continues to assert that they will do that on the short end of the yield curve. But the bond market is bigger than the Fed at the long end. And essentially, they're seeing a reopening. They're seeing GDP forecasts of 6 to 7% for 2021.
And by the way, 9% by the Atlanta GDP. But go ahead.
Right. Well, that's for the first quarter. But basically, what you're seeing is a reallocation of assets, because as we talked about when we mentioned that we had trimmed a large cap growth fund out of our portfolio a few weeks ago, the reason we did that was we feared that higher interest rates would cause a revaluation of large cap growth stocks to the negative. It doesn't mean those companies aren't fantastic. It just means that growth is going to be less scarce than it was during the pandemic. And as a result, the market's going to broaden out and look for other areas to invest where valuations and economic prospects are improving more rapidly.
And so when short-term rates go up, there is also this competition between stocks and bonds, and that's where I started. Is money coming out of the equities market and going into fixed income market? Well, we'll have to see if that's part of the reason why yields are going up. But the other thing that you have to take a look at is the amount of money coming into the market. $3.3 trillion of stimulus already, and another $1.9 trillion is on the drawing board. So is that additional money going to also drive up rates?
Well, we do know that personal income, shockingly, last year was up 13%. That was, whether it was through unemployment benefits, PPP, people that didn't lose their jobs. So people are feeling pretty flush. They have a lot of cash. They've got a lot of built-up, pent-up demand, as you've talked about any number of times, Dave. And it's going to go somewhere, and some of it will certainly migrate into the equities market. Some might go towards reducing people's indebtedness, but some may also go to new car purchases.
That's right. So that's called the wealth effect. And Danny, we've done lots of pieces about snowmobile sales and boating sales just going through the rough.
For sure.
Yeah, that's right. And, there's so much of that could go into durable goods purchases, and we are seeing that. And, the ability for people to fly, it's starting to happen. So you've got vaccinations coming. You have virus on its heels, we hope, right now. You're seeing more money come into the market. And so this reflation trade is really part of the conversation. But when people talk about inflation, it's not 1979. It's not 1980. What are they talking about?
Well, right now we're talking about commodity inflation. We know that copper prices are up substantially. Lumber prices up substantially. Food prices, we talked about that being at a 6-year high several weeks ago. So you're starting to see price inflation in commodities. We're not seeing wage inflation, which is the key component, because that's where you get it, kind of built-in inflationary expectations, is when you start to see sharp increases in wages. And although we know Janet Yellen is poised to try to get that to happen, it's going to take some time, and there's still too much economic slack with almost 10 million people unemployed.
And not only here in the United States, you'll all remember that Mario Draghi was ahead of the Fed in Europe, which is called the ECB. He is now the prime minister in Italy, and there's going to be free money all around the world, not just here in the United States. So inflation is certainly something to watch for. And as inflation rates go up, what does that do to the real yields and the real rates of return? That's something we have to pay attention to. And Derek, you know very well, we have prospective people come in on a daily basis and ask, is this what I should own right now?